How does property location within Canada impact non-resident rental taxation? If you're a non-resident earning rental income from Canadian property, you might wonder whether your property's location, say Ontario versus Alberta or Vancouver versus Halifax, affects how much tax you pay. The short answer: yes, location can make a difference, but not in the way most landlords expect. While the federal rules for non-resident taxation are consistent across Canada, provincial variations, tax rates, and regulatory policies can influence your bottom line. Let's break down how property location impacts your Canadian rental taxation as a non-resident. Federal rules stay the same. No matter where your property is in Canada, your rental income is considered Canadian source income under the Income Tax Act. This means you must pay 25% withholding tax on gross rent or file under Section 216 to be taxed on net income. The CRA applies these rules uniformly nationwide. So, from Toronto to Vancouver to Montreal, the federal structure of non-resident tax remains identical. But where things change is at the provincial and municipal level. Provincial tax differences. Each province in Canada has its own income tax rates and regulations that can influence how your Section 216 return is calculated. For instance, Ontario and British Columbia have higher marginal tax rates than some provinces like Alberta, which could slightly increase your final tax bill. Quebec has its own tax authority, Revenu Quebec, meaning you'll have to file a separate provincial return if your property is located there. Provinces such as Nova Scotia and Prince Edward Island impose additional surcharges on higher income brackets. These provincial nuances don't change the federal withholding, but they do impact how your net rental income is taxed when filing under Section 216. Regional property taxes and fees. Property taxes are set by local municipalities, not the CRA. That means your annual property tax rate can differ significantly depending on your city or province. For example, Toronto has relatively low property tax rates but higher property values. Vancouver imposes additional taxes on empty homes. Some regions charge foreign buyer or speculation taxes to discourage non-resident ownership. These local charges may not be federal income taxes, but they directly affect your total cost of ownership and your ability to claim deductions. Additional taxes for non-residents in certain provinces. In recent years, provinces like Ontario and British Columbia have introduced non-resident speculation taxes, NRST, upfront taxes on property purchases by non-residents. While this doesn't affect annual rental income taxes, it's part of the overall financial landscape for foreign property owners. The takeaway: your federal CRA tax obligations as a non-resident are the same across Canada, but your provincial tax rates, property-related expenses, and local regulations can vary widely. The province your property sits in determines how much you'll owe when the numbers are finalized. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.